I answer tax questions all year for people about deductions. Should I buy a home? I'm a renter. Do I get any benefit? I answer questions all year on this, and there really isn't like one good answer for it. And with all the talk now in the current administration about changing the tax codes and removing certain deductions and possibly getting rid of the mortgage interest deduction, which I've heard is in great debate. The reason for owning a home was always because that opens up the ability to use a Schedule A on your tax return. So if you go to a tax return, if you went to, let's say, the irs.gov website and said, I'm going to look up the 1040. The 1040 form has 2 pages worth of information about your income. And then it starts to go through and it gives you many schedules that most people don't even use. There's Schedule A, and that's where you can take deductions, and I'm going to go back to that in a second. Schedule B is for like dividend income and interest income and those kind of things. Schedule C is if you own your own business or if you have a rental property that you have as a business, and then you put the income and expense there. And then Schedule D, Schedule E is kind of for people who have passive income. But anyway, we want to talk about Schedule A. So there's some logic to the tax forms for the IRS, and even though people go into hysterics when they see them. Schedule A is set up for people who own homes to be able to take their mortgage interest, their property tax on their the property they live in. It's normally the property you live in. Charitable deductions, medical expenses are on this page, and not reimbursed work expenses. There's a couple of things on that Schedule A that are very important. And in the state of California where I live, one of the nicest things is that you can put the amount of money you pay to the state in income tax on that Schedule A. So let's say you're like me and you're a renter and you don't really have a mortgage interest or mortgage property tax, but you pay a lot to the state of California. That allows you to open up a Schedule A, which normally once you're done putting everything on your Schedule A, it is equal to or is more than a standard deduction. Now, I don't know that people realize if you don't do your own taxes that there's a standard deduction. This current administration is talking about doubling the standard deduction, which means you get it no matter what you own, no matter what you do. And then your software of your the tax software determines whether your itemized deductions on your Schedule A is higher than the standard deduction the government offers you. So that's what we need to think about. We need to look at that Schedule A. Schedule A gives you the ability, if you live in a state where state taxes are due, to put your state taxes on your federal income tax as a deduction. It lets you take your medical. So it's based on your income, so you may not qualify. You could have $6,000 in medical expenses, but that doesn't qualify because you made too much income. My family had a tragedy where we had hundreds of thousands of dollars in medical, and yes, it was a deduction on Schedule A, but we didn't want the medical problems, so we are fine without having a medical deduction on Schedule A. But if you need it, it's there. Then you can take your mortgage insurance, your property tax, all your charitable contributions, and then non-reimbursed expense from your business. So Schedule A gives you an opportunity to perhaps reduce your taxes by more than the standard deduction. Now, here's the problem. If you have bought a house at a very low interest rate, and your interest rate is maybe causes you to pay $1,000 a month in interest on your mortgage, times 12, that's $12,000 of mortgage interest. However, if you're a family of 4 and your standard deduction is $6,000 each, that's $24,000 in the standard deduction, and that $12,000 in interest will not really help you. And I think what I need to do is get into that a little bit more and help people to understand that owning a home doesn't always give you a better tax break. Doesn't always. It has to fit into a formula. And you only really get as much of that mortgage interest as your tax bracket. I know that all sounds confusing, but if you look at the forms and then you understand how it works, you'll get a lot better feel for this. So Schedule A usually means you have more itemized deductions than the standard deduction that is allowed in the taxes. If that's the case, all those itemized deductions will help reduce how much tax you owe. If your itemized deductions are not as large as the standard deduction that's given to each member of your family, then in your household, then your Schedule A, while you fill it out, will still not work for you to reduce your taxes. So of course, people, start to sweat and roll their eyes back when they talk about taxes. But the Schedule A is very, very real tax helper, and it's a very real living, breathing form that you need to understand going forward if you're thinking of buying a home. And now if you own a home and you're not understanding why it's not working for you, or if you rent and you want to see what's the difference between renting and buying, those things are very important in your tax picture. And so we will meet again on this subject, I know it.